Hello, and welcome to the UICCU No Judgment Zone Money Minute. I'm Sheri Shannon.
And I'm Liz Welch. We are both financial coaches at the University of Illinois Community Credit Union.
Listeners, we're continuing our discussion on consumer lending because setting you up for the best consumer lending options is important to us. Last week, we challenged you to check your credit report for free at annualcreditreport.com.
That's right, Sheri. And checking this regularly helps you become more aware of what lenders may see when you pull your credit. They use this to make the loan decisions, set the interest rate, and the terms of the loan.
And this is a great way for consumers to make sure any current loan accounts are reported properly. Another reason to check your credit report regularly is to ensure that all items on the report belong to you. With the increase in fraud and identity theft, checking your credit report is one of the best ways to ensure no one has taken out credit in your name. It can also help you be aware of any outstanding bills that may have been sent to collections that you might not be aware of.
And if there's anything that needs disputed, this is the time to do so before you apply for that loan. Any errors with credit, collections, and personal information can be disputed from this same site.
All of these things can impact your credit score. Speaking of credit scores, let's explain this a little bit more, Liz.
Sure. The FICO score is the credit score that most lenders use to determine your credit worthiness. It's based on the information being reported to the major reporting agencies, Experian, Equifax, and TransUnion.
Yes, and it's broken down into 5 categories. Payment history is the biggest category at 35% of your score and shows how you are making your monthly payments. Making on-time payments helps build a better score.
It sure does. But then 30% of your score is going to be on the amount owed on all accounts and different types of accounts. Keeping your overall usage to less than 30% of your available credit is suggested. Next is the length of credit history, which is 15% of your score. A longer credit history will always keep a positive effect on the FICO score. A good rule of thumb is to keep your credit cards open. When you close one of your credit cards, you will lose all that great history that you have built.
New credit makes up 10% of your score and can improve your score by increasing overall availability. On the other hand, it can lower your score if you apply for credit too often within a 2-year period. So it's best to apply for credit only when you're serious about getting a loan or a credit card.
Lastly, Sheri, is the credit mix, which makes up 10% of your score. This is having a good mix of both revolving and installment credit. Revolving is credit cards or lines of credit that has no end date, where an installment is a mortgage or a personal loan that has an end date.
Liz, to sum it up, it's important to build and improve your credit score. Check your credit report, pay bills on time, reduce the amount of debt you owe, don't close accounts, and have a good credit mix.
That's great review, Sheri. Good credit can work on your behalf and set you up for loan options.
For more financial health resources, check out the financial wellness page at uoficreditunion.org. And remember, if you're listening, you can bank with us. I'm Sheri Shannon.
And I'm Liz Welch. Thanks for tuning in to the UICCU No Judgment Zone Money Minute on WPCD.